Well, the Federal Reserve has just ended their two-day meeting, leaving interest rates unchanged and stating they plan to leave it that way for some time. The investment world celebrated the news and pushed many investments to new highs for 2009. Joe Krier is president of Krier Wealth Management and says to take all this with a grain of salt. You know, it's great to see things going up, Joe, but what?
Yeah, you have to be a little bit careful here. You know, this is the fourth largest bear market and recession in history, and all three of the prior ones had rallies like this along the way before we really got going again. So it could be a head fake.
So, a what? A head fake?
It could be a head fake.
Like a psych out?
Yeah, since we're getting back into football season here.
Oh, yeah, okay. So let's take a look at what the Fed's been saying. You call this summer Fed speak. Tell me about these terms.
Yeah, you know, and we used to call it green speak. Now we have to change because the players keep changing.
Greenspan's no longer there.
They're saying economic activity is leveling off. That means it's getting less worse each month. So, you know, they're saying things might just stabilize here, and you know, you got to start somewhere in a recovery. Also, they're saying inflation remains subdued and that they could leave interest rates unchanged for an extended period of time.
Yeah, we thought that they'd leave them unchanged, so that's not a big surprise. Were there any surprises out of this?
Yeah, well, I don't know. You know, these statements kind of contradict each other if you look at it. Leaving interest rates unchanged for an extended period of time means that they don't expect the economy to actually recover, because they do want interest rates to go up a little bit. A little bit of inflation is a healthy thing, and if they're sitting here flat or even declining in prices a little bit, that's actually a bad thing long term for us.
All right, so what's driving this latest round of optimism in the markets?
I think it really gets back to the fact that we don't have companies coming up to the brink of extinction every week. You know, for the longest time, 6 months there, it seemed like every week we had one bank or another or brokerage firm or something that was about to go under. It's been pretty quiet here, and the bad news is still not great, but it's not as bad as it was before.
Yeah, when you say economic activity is leveling off, you think, well, great, it was up here, and no, you're saying it was down here,
right? And
now it's just going steady.
Yeah, and
it's not getting worse.
Correct, and we feel that leveling off might just mean, hey, we're going to bounce along the bottom for a while, and you know, that's okay too, but let's not get overexcited about it.
Okay, so let's talk about keys to real recovery. When we start seeing these things, we should feel a little more comfortable. Is that what you're saying?
Yes, and you know, and right now we're not talking about jobs at all. The Fed didn't mention it. You know, their two things are to control inflation and to keep unemployment low. And they didn't talk about unemployment because they know it's probably going to go a little higher here. So that we have to watch for that to stabilize. We do need real estate prices to stabilize, and depending on who you ask, they have or have not. We think they're going to go down a little bit more because there's just a lot more mortgages out there that haven't reset yet, and there's a lot of banks holding inventory. There's a lot of empty homes. That's just got to work itself out. And
just read a new report, by the way, this morning that said 7% more foreclosures forecasted.
Right. Yeah, and you know, and that's where I put the word time on there. Just time helps. You know, time helps. Cars get outdated, so people have to replace them. They eventually need to replace the washer and dryer and refrigerator, and that's what kind of gets economics going again.
And one other thing that you put on here, your keys to real recovery, is consumer spending.
Yeah, consumers make up 70% of the U.S. economy, so if we're saving money and not spending it, it's a good thing for us, but it's bad for the economy. And Walmart's going to report its earnings sometime in the next 30 minutes here, which makes up 10% of all retail spending. It'll be a good indication of how back-to-school spending and how consumers are feeling in general.
Do you feel this recovery is imminent?
I'm going to say no, just kind of taking a stand. I think that coming back from the brink of, you know, all-out disaster, we're beyond that point, but I don't think we should get excited that things are taking off. And the best thing to do is to kind of sit back here, relax, and just let time take its course now.
I think this has changed a generation, don't you? What's
Definitely.
happened?
It's changed our psyche.
Yeah, it has. Thanks. Joe Krier, president of Krier Wealth Management.